Hey everybody, CitizenTraderX here. In this video, I'm going to go through and show you how to use my lot size calculator spreadsheet. If you don't already have the spreadsheet, you can get it from Etsy. Just look up CitizenTraderX lot size calculator. I do have it in Excel and Google Sheet version. All right, so if you have it, obviously you're here to understand how to use it. If you don't have it, you're probably here just to see what it's all about, and do I need it? So yeah, stick around. This will help you make that decision. For anybody who has not seen my previous video, I do go through the math on how to do the calculation, at least for this first tab that we're looking at the moment, the simple version. I do not go into how the leverage part of it is calculated, and of course I do not go into the fees part of it either. So FYI, the math is only for this the simple version of the calculation, which will help a lot of people, in which case you can just use that. So let's get into it. Let me just quickly, I just flashed the 3 tabs, but let me just quickly explain what each tab is, and then we'll go through and explain each one and how to use it. So this is the first tab. If you look down here, you'll see it's called dollar gap. So because we're using the dollar value of the coin we're trading, so we're going to use Bitcoin as the example. So the difference in the dollar price is the gap, and that's how we determine our lot size. The next tab, we introduce leverage. So we're going to introduce the amount of leverage that we want to use, and therefore to determine how much equity we actually need to place the trade. The third tab just adds a bit more information. Let me just minimize this so we can see it all, or most of it. Maybe we need to go smaller. And basically in this one, so we have leverage. So basically you've got your basic calculator. Whoops, what's going on here? Got the basic calculator, or here we've added the leverage, and then we added a bit more information, the fees. So fees can come into play. I mean, they obviously reduce our profit and increase our losses. And sometimes it's not much, but we'll show an example where it can actually affect it a lot. So you need to be aware of it, because you might be trading a gap that's so tight that the fees just don't make it worth it. Yep. So that's the third tab with the fees information. All right, let's go back to the first tab. Let's get back to largest size so we can see what's going on. Now, on all the tabs, I do have some explanation on the right side to try and give you a guide, so you don't have to keep watching this video. Watch the video once or twice, or watch it as many times as you need, but the instructions here will tend to give you what you need to know. The other point to be aware of is only enter values in the yellow fields. So I have highlighted those fields in yellow. They're the only ones you want to be entering information into. The other fields will have calculations, so you don't want to be messing those up. And the other area where you can enter information is in this drop-down menu, so the trade direction, whether you want to go long or whether you want to go short. Yep. So stay clear of the other ones. If it's not yellow, don't enter anything into it. Of course, you just, I guess the safest thing to do is make another copy, rename it, and just use that one just in case. Okay, so in order to go through this, we should use an example. All right, so here is Bitcoin. We're in January 2022, currently at 42,756 USD. All right, so let's use this chart to enter a trade. Pretend we're going to enter a trade and use the calculator to understand what that trade is going to be worth. So first thing you want to decide is how much you want to risk. So we're going to keep it simple. Let's do 100. Let's go back to the chart. So let's just say your technical analysis has told you that if price closes above this line here, you enter for a long, and you believe that the price may come back and test these lower wicks, but you believe it won't go this low. So you're going to put your stop loss in here somewhere. Okay. Now this tool is great because it tells you the risk reward ratio. Now let's go for something more realistic, like 1 to 2. So keep moving this up until you get a 2 or close enough to it. Come on, mouse. All right, let's just leave it there for now. Okay, so 1 to 2. So we're prepared to risk $100 to make $200. Yep. So this is what our technical analysis told us. This is what we believe. We believe this is a safe level for our stop loss with our target up here. So just to highlight, this is our entry price, and we believe the price will do something like this, and eventually, boom, hit our target level up there. So let's just switch this guy. All right, so this is what we believe. We believe the price will not go lower than this, which we call our gap, and therefore we're prepared to risk $100. If the price goes below or touches, and we do have our stop loss in place. Remember, of course, this is all assuming that you have entered your stop loss. If you do not, well, that's on you, and that's a totally different story. So if the price drops to 40,058, we will lose $100. Okay, so we need to know, and we want to double our money. So we need to know how many Bitcoin we need to buy in order to risk $100 to try and make $200. So this is where our calculator comes into play. We want to risk $100. We're going long. Our risk to reward is 1 to 2. So our reward target is $200. What's our entry price? It's the grey line here. 43,204. 43,204. What's the stop price? Stop price, we believe we will not go below this red line. 405.8. 8. Okay. This is the lot size. So, calculator is telling us in order for us to risk only $100 to try and make $200, we need to buy 0.03 Bitcoin. And it gives you the take profit price. So let's just see if the calculators, if the chart is close. 49,496. 49,496. Okay, remember we're a bit off because we're not exact. Can we get it exact? Even if we got it exact, it wouldn't be exact number because we're using a mouse. But it's close. So this is the value. This is the value you would enter into your trading software as a take profit level. Now, there is an instruction here. If negative, check the trade direction or your entry or stop prices. Because if you have this the wrong way, you're going to get a negative value. So that's telling you, first of all, it's highlights in purple, and it's telling you, hey, something's wrong. So check your direction. Now, not only can your direction be wrong, or in this case, but so let's make it correct. But also you may have these mixed up. You may have flipped them over. So Because we're going long, your stop price is always going to be lower than your entry price. So let's just pretend we made a mistake and we put it above. So again, we get a purple color, it's a negative value, something's wrong. Check your trade direction. If not, it's your values here, either this one or this one. So we're going long, so the stop price should be underneath. I believe it was 40,000. Okay. So that's the simple calculator. Enter your entry price, enter your stop price, how much you wish to risk, what your risk to reward is, the direction you're going. And that's it. Let's do a short example. Let's just delete this stuff, just to give you the full understanding. Let's get rid of all this. Okay, so instead, your technical analysis, instead of saying that you should go long, it's telling you that you should go short. And it's saying if you close below this level, and for some reason that level there, your technical analysis is saying the price will not go above that, then that's your stop loss. Again, let's go for 1 to 2. So let's see how close we can get this one at 2. This time. Oh, there we go. Okay, so let's just bring in some more chart. Let's see. Alright, so what your technical analysis is telling you is that once the price closes below this level, you'll enter a trade and the price will not go below up above your stop loss, but will in fact go down and cross. Let's change it to green because it's positive. Your take profit. Yep, just doing that. So you're saying you will not cross this stop loss level. Yep. All right, so we have our entry price, the gray. We have our stop price. We know how much we want to risk, and we know the direction we want to trade. So let's go back to our calculator. We want to risk $100. Yep, remember what we're saying? We're saying if the price crosses our stop, that's when we lose $100. That's our gap from entry to stop. So we're risking $100. We're going short this time. We're still 1 to 2, meaning our reward target is $200. Our entry price now is 42,431. 42,431. And our stop price, because we're going short, is above. So it's 45,687. 45,687. There we go. So in order to play this trade, only risk $100 in this gap. To try and double our money to here, we need to sell 0.03 Bitcoin. Now I do show a lot more decimal places here, because if you got something like Dogecoin or something that's really cheap, you're gonna need more decimal places. But for most brokers, I think you'll probably only get 2 decimal places for Bitcoin. That's why I'm saying 0.03 as an example. But all the decimal places are there. If your broker allows you to put more decimal places, totally up to you how exact you want to be. And the take profit level is 35,919. Let's see if we're closer this time. 35,919. 35,918.91. So that's pretty damn close. That's because we're able to get that to the number 2. using our mouse. Okay, so that's how to calculate the lot size of a short, not taking into consideration fees, not taking into consideration leverage. Okay, so now let's go and check out the next tab, the gap leverage tab, where the only thing we've added, if we look at these two, we add the leverage, that, and these two, which give you the information about the use of the leverage. That's the only difference, but the formatting is the same. Only enter information in the yellow cells, and of course choose your direction with the drop down menu. Again, I have instructions in this column, and yeah, let's go through it. So we're going to do exactly the same thing, use the same chart, same examples. So let's go long. Again, okay, your technical analysis says once price closes above this value, oops, we got the wrong tool. We want to go long first of all. All right, so once the price closes above this level, we want to enter a long trade. We believe our stop loss is safe here. We want to go for a 2-to-1 or 1-to-2. It's interesting that, because most people say 2-to-1, but then they'll call it a risk to reward rather than that. You know, it's not 2-to-1, it's 1-to-2. So that's why I try to say it the correct way, even though it's not the way everybody says. But you get it. So it's a 1-to-2 risk to reward. Yep, we got it on 2 this time. Okay, same deal. Technical analysis says enter here, stop here, take profit here. Bing, bing, because we believe the price will do this, zing, and double our money. All right, so let's enter some information. Let's go back to the chart, to the spreadsheet. Okay, we want to risk $100. We're going long, so we're going to leave that. Risk to reward to ratio. I've left it in there the way people say it, but anyway, you know what I mean. 2. So we're trying to make $200. Entry price 43332. Stop price is 4124. And if you're not going to use, if you're not going to use leverage, like I'm saying in the instructions here, just leave it as 1. So 1 times the amount of money you have. But if you're going to do that, you might as well just use the normal calculator, because that is, no leverage, so 1x. All right. So, okay, what is this telling you? What's the information that it's telling you? Okay, besides the lot size and the take profit level, which we get from the basic calculator, the extra information we're getting is the actual cost of the trade. So this is the other thing you need to think about. Just because you only want to risk $100 doesn't mean that's all you need to have. Because the actual trade costs more than $100 to enter. You only want to risk $100, but the actual cost to make the trade is $1,350.75. Remember, we're not including fees at this point. That's in the next tab. So if you don't have margin, so if you just want to 1x of your equity, then you must have, so this is telling you the actual trade cost, and this is telling you how much equity is required. At this point, because we only have 1x, you need the same amount of money that the actual trade costs. Yep. Now, if your broker lets you do a 10x, now things change. So basically this is saying that they're giving you 10 times the equity that you have. So the cost of the trade remains the same. The trade, no matter what margin, what leverage you use, the trade itself still costs $1,350.75. But with 10x leverage, you only need to have $135.07 in your account. Yep, because the broker is giving you 10 times that value. Now, obviously you cannot have this exact amount. You need to have more, because that's when what comes into play, the margin calls or liquidation price. So to ensure that it does not lose money, you need to have a bit more. It's not going to be able to stop a trade exactly when the price reaches a point such that you are losing $135.07 exactly. So what will happen is the liquidation price will be higher. So you won't be able to risk this whole $100. Maybe it'll get to, let me go to the chart. The price, depending on your broker, if the price, let me just get this color right. If you have the exact amount, 135.07, the broker may only let the price go down this far before it closes your trade. Because it doesn't know if the price may suddenly go like this, like super fast. And if it does, let me just move this up. If the price suddenly does do a crazy dip like that, you only have enough money to cover to here. But the price has dropped to here. So by the time the trade automatically closes, the broker has got this money from you, but it does not have this money from you. Now, as you know, it's super easy to get a brokerage account. Some of them you don't need to show ID. Obviously, once you get into higher values, you do. But this is the problem. And even if you do, if you've done all the KYC, it doesn't matter. The broker wants to protect itself. It cannot get this money back from you. It may try, but it's more difficult to get money from you than it is to get money that you already have in the exchange. So this is why, let's change this color. This is why it will cut off your trade at this point. Each broker has their own calculations, liquidation price, and most of them have the calculator, so you can enter it and it will tell you. And some of them will show you even on the when you're doing the trade. So if you have the exact amount, $135.07, do not expect that you have the freedom to let the price go all the way down to there before coming up. No, it'll be cut off. Your trade will be cut off earlier. You'll be like, oh, what the hell? What happened? I had a stop loss. I was only risking $100. Yes, but the broker needs to be safe and make sure it doesn't lose money. So it does not want to let the price drop below here where you don't have any money in their account. This is what I'm saying. Yes, this is the actual trade of the cost. This is the actual trade cost, and this is how much you need in there, minimum. But anyway, that's it's a guide. That's the exact figure, but depending on your broker, will determine how much money you actually need, to actually risk $100. hopefully I'm being clear in my explanation. Leverage and margin is a liquidation can get tricky, but it's pretty simple. Let me do a short example. It's exactly the same, but maybe I can clean these squiggles up and make it a little bit clearer. For the second time it'll make sense. Let's just get rid of all of this. Okay. Hey, what's going on here? Okay, let's go to that tool, the infamous brush tool. All right, let's clear these things as well. Let's start fresh. I mean, this is why, you get these brokers offering you 100x. It's like, fantastic, I only need $10 and I can put, a $1,000 trade. Well, you can, but it'll probably close your trade and take your money when, the price drops only 50 cents. You'll be like, and it takes your $10. You'll be like, hey, what's going on? Like, yeah, the broker is trying to protect itself. So where are we? Okay, we want to go short. Get the short tool, short position tool. If the price closes below here, we enter. We don't think it'll go above this level here. That's what our TA has told us. We're going for a 1 to 2. You can do it. No, I can't. All right. So our TA says we enter here. We put our stop loss here. And we believe the price will hit our take profit. Take profit level, which is down there. Yep. Let's go here. Let's mix it up. Let's say we got $500. No, we don't want to risk 500. We want to risk $50. Okay. We want to go short. Risk to reward. We want to try and make $100. So it's 1 to 2. There we go. We're trying to make $100. Entry price now is 42,434. Stop price is 45,493. Leverage is at 1 again. So once again, we get our lot size in order to risk $50 in this gap. We need to sell 0.016 Bitcoin. Our take profit is 36316. 363. Okay, close. Remember, we're not 100%, but it's close enough, and it's the calculator's right. So to make this trade, so in order to sell 0.016 Bitcoin, the trade itself is going to cost $693.59. Yep, that's how much you're going to spend to enter this trade. And if you're not using leverage, you're just using 1-to-1 of what you have, then the actual amount you need to have in your account is what it costs. All right, so let's say we have 5x accounts, 5x leverage. What this is telling us now, the actual trade costs still the same, but we only need 138.72 cents in our account, minimum. Yep. So what does it mean? We're prepared to risk $50 here to make $100 here. if we stick to the minimum, if that's all we have in our account, we use it to trade. Believe you me, if the price does this, somewhere like this, you're going to get stopped out. Not stopped out, liquidated. Your trade will be closed. The broker is trying to protect itself for anything like this and not being able to retrieve this money. I think this graph is messier than the previous one. So, alright, so I won't go into it anymore. I'm sure there's lots of videos out there that explain leverage a bit clearer. Hopefully the first version of my example was clear. I need to remember this is not a video explaining what leverage is, but explaining how to use the leverage calculator. Yeah, it's just something, so just be careful, be aware, you need more than the minimum. This is the minimum. Maybe I should call this minimum equity required, just to make it clearer. Can we do that? Let's do that. Minimum equity required, there we go. That makes sense. All right, so enter the risk, enter the direction, enter your risk to reward, entry price, stop price, add your leverage. If you're not using leverage, as my instructions say, just enter a 1 in there, or even better, use the other calculator. If you're using leverage, of course, enter your leverage. This is how much Bitcoin or whatever coin it is you need to sell. And to sell that amount, you need to have this much money with no leverage and this much money with that much leverage. Cool? I hope so. All right, so that was the dollar gap and leverage tab. Okay, let's go and check out the next tab, which is dollar gap and leverage and fees. So the difference here is that we're going to take fees into consideration. Let's just make this a little bit smaller for us so we can see. Still not enough. Let's go down a little bit so we don't need the title. All right, that's everything on the screen. Okay, so I'm not going to go through everything again because it is a repeat. So all of this is what we already had in the previous screen. The difference now is that we have maker fees and taker fees. So depending on your exchange, they will have different fees. We can look at, this is Bybit, so to compare, let's go to USD futures contracts. So here we got the maker fee and a taker fee. Now in this case, it's called a maker's rebate because, as you'll notice, it's negative. If it's negative, it means you actually get paid that much, that percentage. So rather than paying a fee, they pay you. Yeah. So whether you're aware or not, some brokers will actually pay you, not just charge you. If we go to the next page, so this is Binance to compare the same USD futures. So this is the maker taker fee. So in the Binance situation, you're charged either way, whether you're a maker or a taker. You're gonna pay a fee, while Bybit will actually pay you if you're a maker. Quickly, just to explain the difference between maker and taker. Maker means you're adding liquidity to the market, so you're trading with limit orders, so your order does not execute immediately. So you put your trade in and it sits there for a while. That means you're adding liquidity to the market. So brokers reward traders for doing so, because having transactions in there saying, hey, I want to buy, or hey, I want to sell, entices people in. So an order that does not execute immediately is considered to be adding liquidity, and therefore you're considered a maker. Therefore, in the Bybit situation, they'll actually pay you, in this instance, 0.025%. If you're a taker on the other hand, that means you are removing liquidity from the market. So, that's when you do like a market order and your trade executes immediately, and there's no time for your trade to sit there and, create positive or negative. It just immediately takes money out. It takes the trade out. So that's what's considered a taker fee. So because you're removing liquidity from the market, I guess you're punished, if you want to look at it that way. You're removing it, therefore you have to pay a fee. If you're adding, in this instance, you get paid. But in Binance, you're paying either way. You do pay a reduced fee, of course. So if you're adding liquidity, you get a cheaper fee. If you're removing liquidity, your fee is a little bit more. So things to consider when you're obviously assessing the broker you're going to use. How do you normally trade? Do you always trade market, into market trades, or do you use limit orders? And what are the values of these fees? Because they can make a difference in your trading. So let's go back to our third tab, and let's just let's enter the same information. So 50, just so you can see the difference. Shorts, what was it, 2, entry price 42,434, 42,434, stop price 45,493, 45,493, leverage was 5, correct? Yep. So lot size 0.016, take profit value 36,316, 36,316. Okay, leverage is the same, leverage is 5. Okay, so we have the same example information that we had before. So we can look at this. Let's just remove some of this. Looks like an old, there was a show called, what was it, Mr. Squiggle. A really old show. Anyway, it looked like that. Alright, so it's the same situation. Technical analysis says price is going to go down and it's not going to go higher than that stop loss. So here's the information we need, just as before. We need to sell 0.016 Bitcoin. That's how much the actual trade is worth. This is how much, let's change this one then, eh? Let's make it what it's supposed to be. Minimum equity required. Yep. Alright, so now we have these new fields, make a fee and take a fee. And let's just use the Bybit version, because whether you've seen this or not, it just makes for interesting viewing. So make a fee of minus 0.025, minus 0.025, and what was it, 75.75. Okay, so what are we seeing here? Now, this is going to explain to you, the different types of trades that you can do. So if you market in and market out, this is the total fee. Yep, it's made up of the first trade, which was getting into the trade. So you marketed in, it cost you 52 cents. If If you market it out, it costs you 52 cents, because remember, market, you're removing liquidity, so you're getting charged to take a fee. You're taking liquidity, that's what we can call it. So that's the most expensive one. Yep, both trades were charged at the taker fee of 0.075%. So therefore, total fees is $1.04. So now this row here is if you won. So if your trade was profitable, is the value. So remember, our profit target was $100. So if we were successful in this trade, yep, and our price went zzz, bing, and made us some money, then we would have made $100, but we need to minus the total fees, which gives us the 98.67. Yep. Clear? All right, let's look at the other extreme, which is limiting in and limiting out. So this is the situations where you use limit orders to both get in the market and get out of the market. As I explained, limit orders are encouraged because they add liquidity to the market, and in the Bybit situation, well, for USD futures, you're getting paid. That's what the negative says. So I've written it here just in case you forget. Enter the exchanges, make a fee. A negative fees mean you get paid. All right, so because we're adding liquidity, because we're limiting in and limiting out, we get the best rate, which is the minus 0.025. In these sections, a negative means we're being paid. Yep. So if we won and we were going for 100, what do we get? We get $100 minus the fees. And in this case, the fees, we're getting paid $35. Therefore, we actually make $100.35. Yep. So compare this with the worst scenario where we market in, market out. Instead of getting the $400, we get the $100 minus the fees, which were a positive value. But if we limit in, limit out, we actually get paid a little bit more, so no fees. So the $100 which we wanted to make, plus what Bybit pays us for adding liquidity to the market. These two are a mix of both, so whether you limit in and then market out, they're the fees, or whether you market in first and then limit out. It's just the flip of the fees. So that's the row there to determine what your final profit will be. Of course, remember, none of this takes into consideration things like slippage and however exactly your broker may work. So, but these are a guide, and this is what you're looking for. Let me just show you the next row before I show you where this fees really come into play. So this is the row that will show you what your net loss will be, considering the fees. So if we lost through a market in, market out trade, remember we're risking 50. Yep. But if we lost, we'd actually lose $51.04. Why? Because of the fees. Yep. Remember, this is the worst case scenario. We charge the most fees because we're taking liquidity through a market order in and a market order out. Therefore, we pay the most fees. Therefore, we don't only lose 50, but we also lose the fees as well. Compared to the best scenario where we limit in and limit out, i.e. add liquidity, we don't lose the full $50 because we're getting paid 35 cents, so we only lose $49 65 cents. Yep. So in this situation, because we're the gap, this here, so let me just click on this. So when you're determining gap, using the spreadsheet we're using and using the math that I showed in my previous video, and the reason I called it dollar gap is because we're using the dollar value, but you could also use a percentage value. Now using this tool you can see the percentage value here. So basically what you're saying is if price from entry moved up 7.21%, that would be my stop loss. Yep. Now in this case that's a large enough gap that the fees are quite low. So in this instance you're looking at it and you're going, well, I'm risking 50, I lose 51, no big deal. Here I'm risking 50, I still lost 49.65, you know, no big deal. So you may be asking yourself, well, what's the point in bothering with the fees calculation, you know, viewing it? So the problem comes when, and it's mainly in the lower time frame. So if you look at this, we are in the 4-hour time frame, right? And therefore our movements that we're expecting are larger, 7.21%. Problem comes when we let me can go to the next window. Yep, let me get to see up here. Oh, got some crap on here. Let's clear that. Clear that. Clear all this. An old chart that I haven't used in a while. Okay, so the problem comes, so now we're on the 1 minute chart, right? Compared to the 4-hour chart. Yeah, so this, we're going to go zoom into this area here, which is the 1 minute chart. Yep. This is when the problem of fees come into play and people get excited, go, oh, I can make money from this tiny movement. So let's go long. Oh no, let's go short. Because my TA says so. Oops, let's get rid of that. Alright, so our technical analysis tells us if the price closes here, below here, we'll enter. We don't believe the price will go past that level, so we'll put our stop loss there. Yep. And we want a 1 to 2 risk reward ratio. Close-ish. Oh, there we go. Yeah, so that makes sense. That looks good. So what are we saying? We're saying if we enter here, we don't believe the price will go above here, our stop loss, because we believe the price will drop down and hit our take profit. Yep. Basically the same thing we were looking at before. Let's go back to that chart. Yeah. You know, we got levels, we draw levels, we believe certain things. Fine. The difference now is, sorry, let's go back. If you remember, the movement we're waiting for, or we're not hoping for, is 7.21%. The movement at this smaller time scale is 0.22%. Yeah, so that's a much smaller movement, and this is when fees become a problem. Okay, so we were like, okay, I'm prepared to make this trade. This is my gap, where I'm prepared to risk $50 to make the $100 down here. All right, let's enter some numbers. So let's change 50 short, that's fine. 2 entry price. What's it at now? 42758. 42758. Stop price. All right. Stop price is 42758. 42758. Leverage can stay whatever it is. Oh, what have we done? We've repeated something. Stop price is 42,852. Sorry, 42,852. All right. So now, because the movement we're playing with is so much smaller, I didn't want to show you the bottom. Anyway, whatever. First of all, things you need to be aware of is the trade is going to cost $22,743. Yep. Meaning, whereas before, what we're looking at, 135, 138.72. Now, you need minimum $4,548.72 in order to make this trade. Yeah. So, same risk to reward, same leverage, but it's going to cost you a lot more because we're playing with a much smaller percentage move. Yeah. Remember, it's 0.22 compared to 7.21. Yeah. And how do the fees compare? All right. So the numbers are in. We're using the Bybit figures, so you get paid. Now, let's look at the profit. So remember, we're risking 50. We're trying to make 100. If you traded and won, if the trade was successful, and you market it in, you market it out, you're not going to be paid the $100. You're actually going to lose. Yeah, the $34.12. That's the fees. Look at the fees now. $17, $17. Yeah. So the tighter the gap, the smaller amount you're trying to risk, the smaller amount of movement you're trying to take advantage of, the more it's going to cost you to trade. Yep. So, I mean, this is, half of your risk, right? Or more, obviously. So instead of making the 100, you actually only make $65. Forget slippage and all of that stuff. Yeah. Best case scenario, in Bybit situation, you're actually going to make more. Yeah. So in this case, it's great if you limit in and limit out. So you're going to make your 100 plus the fees that you're getting paid. You're actually going to make $111.37. Fantastic. Now remember, that's if you're with Bybit. Remember, Binance, you're actually going to charge. So there's always a fee involved with them. So this will be under $100 again. Now let's look at the net loss, because this is where things start to add up. Remember, we only want to risk $50. Now if you lose, you're losing $50 and the fees. So you're going to lose a total of $84.12. Yep. Obviously, the blow is softened if you limit in, limit out. So instead of losing the $450 because you're getting paid $11.37, you're only losing $38.63. Yep. Now again, here you may be looking at it. Yeah, like I said, it's only $30 more, whatever it is. It's not a big deal, but you can see that it's starting to creep up. So, before it was, what was it? Oh, it was on the other page. We're talking $1 or something, we're talking 17 cents over here, but now we're talking about $34. You start to compare $34 to the amount of risk, you're actually risking $80. Is that what you're prepared to do? No, you only wanted to risk 50. So fees do start to become an issue. And of course, they become even more of a problem if you start going in here, it's like, okay, well, you know what? My TA is actually, well, look at this. Let's get in there. My TA is actually saying, if I get in there, oops, let's leave it there. Let's go back, leave it where it was. But my stop loss says it won't go past there. Yep. And then we can put that to 2. Yep. So now we're like, you know, you start to zero in. People start to do this. You know, you got people out there who are trading on the 10-second and 1-second chart, which is just crazy. Whoa, what's going on? Obviously, everything's magnified when you're zoomed in like this. All right, so let's punch in these figures. So entry is the same. The difference is the stop price. Because now we're looking at 0.11%. 42,802. 42,802. All right, so, you know, now we're looking at even smaller movement. Now we need, you know, the full cost is 48,588. With 5 leverage, we need minimum 9,717. You know, it starts to build up. So you need to have a lot more money in your account. And remember, this is the minimum. As I explained before, with liquidation, you need more than that, or else before your stop loss is even hit, all your money will be taken out, if that's all you've got. Now let's look at the fees. So we're still risking $50, but it's going to cost us, if we are a market in, market out trader, it's going to cost us $72.88 to trade before even making or losing money. So when you do lose money, you don't not only do you use the 50, but now you add in the $72 fees, so your total loss is $122. Is that what you're expecting? No. That's the whole point of creating this calculator, to determine where your risk is, what your maximum risk is. $50. But now we're losing $122. Of course, we get paid a little bit more, but that's Bybit. Not everybody pays, remember. Yeah, so instead of winning only the 100, we get 124. But you know, these things start to become a problem where you're losing more than you anticipated. Yep. And not only that, of course, is the fact that you need more money to make the trade. Okay, I think that's pretty much it. So just a quick recap. The original gap is no leverage, the simplest method. If you're not trading with leverage, fantastic, just use that one. If you're thinking about trading with leverage and you want to know how much money you're going to need, use the gap plus leverage tab. Determine the actual cost of the trade and how much equity you need to have minimum, considering the leverage you're going to use. And if you're starting to get tight on the, anyway, just if you're not aware of how much the fees are going to cost, use this tab, punch it all in, get an idea. You'll start to get an understanding, you know, when, okay, 0.11, oh, that's pretty tight. You know, I'm on lower time frames. It's going to be expensive if I'm looking for tight movements. If you're looking for trades, you know, big, larger movements, 7.7%, then the fees, of course, depending on how much you're risking trading with, will affect it. So let's go back. Okay, I think that wraps it up. I hope I was clear in showing how the spreadsheet works. I know I did go on a couple of tangents explaining certain different things, obviously the maker-taker, the leverage and how much you need, and how brokers try to protect themselves by, you know, cutting your trade short because just to protect themselves from any spikes in price, whether it's a pump or a dump. But pretty straightforward to use. Only punch in information in the yellow cells. Choose your direction. That's pretty much it. Of course, I have instructions on the side in case you've forgotten. Obviously, you can rewind this video, watch it over and over as many times as you want. Just to wrap up again, this video was mainly to show people who obviously have the spreadsheet how to use it, how to use each tab. If you don't have the spreadsheet, you can get it from Etsy. Look for CitizenTraderX. And if you don't want it, you don't need to know about fees, you don't need to know about leverage, you can watch my previous video where I go through the math of trading short and long. But of course, I don't talk about leverage and fees in that one. That starts to get a bit more complicated with the math. So check that video out. And if not, you can get the spreadsheet and then watch this video again. That's it. I hope this video wasn't too long. Thanks for watching. Thanks for buying if you did. And happy trading, and see you on the next one.